Hi, this is Lex, and welcome to the Fintech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and welcome to today's conversation. I'm really excited for today's topic and to welcome Asaf Horesh, who is the general partner at Vintage Investment Partners. We are going to cover the venture markets, both the fintech venture market, crypto venture market, as well as the structure of investing in funds and what the current trends are. So with that, Asaf, welcome to the conversation.
Hi. Great to meet you, Lex, and thanks for hosting me.
Happy to. How did you get into venture? What were some of the early experiences before you really kicked it off that got you to engage with business, that got you to engage with kind of like early technology themes that brought you into the space?
Good question to start with. So I was born and raised in Israel, very kind of traditional background, middle-class family, and then joined the army like most people do in Israel, and went to flight academy and spent 8 years as a pilot in the Air Force. So up until I was 26 or 27, I had anywhere between very little to zero experience in business and venture. Then did my bachelor's in computer science in Tel Aviv University. And during that time, sort of made up my mind that I want to do an MBA abroad. So that kind of led me to do my MBA at Wharton in Penn. And during that time, I think I wanted to kind of get more experience to, investing, and specifically, don't ask me why, was more intrigued into private equity and started kind of putting together some network and reaching out to people and speaking to people, which ended up being more of a venture network just because Israel is very techy and most funds here are venture funds. So after graduating Wharton and spending 2 years in the US with the Boston Consulting Group, we moved back to Israel actually just slightly more than a decade ago. Obviously, I was already married and I had kids, and we moved back. And initially, the intention was to move back with BCG and then start kind of, exploring here. I got approached by what was back then the office of Greylock Partners in Israel and in Europe. And that's when I started venture. So it's, I would say, a very high level. It's kind of half intentionally and half opportunistically.
You have some pretty great training, right? From private equity to consulting at BCG to Wharton Finance. What were some of the kind of the early frames that you picked up doing that? Because especially since that was the entry into your investment career, what were kind of the cornerstone lessons that you had gotten out of those experiences before you got to venture?
It's a really good question because in the first 2 years when I was at Greylock, I was asking myself, actually, am I or can I be a good investor? Actually, still 8 years into now being general partner at Vintage, I'm still asking myself the same question. But
what is a good investor?
The answer I gave to myself initially was, and why I'm actually getting into this asset class, because I don't know, I assume most people want to be successful at what they do. So I was kind of looking at, I said, hey, listen, technology, you somewhat know technology, did your computer science in Tel Aviv, and I spent a couple of years with a startup and another corporate. So let's assume I know some technology, and I should know a little bit about finance, given the time I was, at Wharton, and a little bit of private equity. I know I'm very good with numbers. That's something that I know. And also, I know a little bit about strategy, given, as you mentioned, all this kind of cornerstone. And then I was really surprised to figure out that these are all nice to haves it's just a people's business. Like at the end of the day, it's about the best founders and the best investors. They pick you and you don't pick them. And you want them to want to work with you. So if you ask me what are the so and then kind of that's kind of how I view, investing in business and venture in general.
Interesting. So, if you were to ask a public equities investor what makes a good investor, they might start talking about, fundamental analysis, or if you asked a quant, they might talk about asset allocation or some macroeconomic factors or things like that. But your experience in venture and fund investing is about the people. And can you open that up? Like, what does it mean? Do you have examples of the advantage that you get from access to the right people? And then what are some of the characteristics that over your time doing this you think are really bright signals in venture?
So I think when I try to explain venture to people, the first thing they say is like it's a very kind of unpredictable and risky asset class. And I think from the outside, it does seem like that. But if you actually look at the asset class as a whole, it might be the most predictable asset class that's possible. It has some limitations, and we'll get to this. But you mentioned public equity. I don't think there is it's sort of a random walk, right? So all the information is open for everybody, and whoever is better at analyzing this or kind of looking at the future, then they have some advantage. But honestly, it's sort of a random walk, and that's backed by research. And then if you look at venture, the brand of a person, of a partner, of a firm is probably the most important thing to have, because eventually, pick one of the top founders, like in Israel, let's say one of the top founders is Asaf Horesh, who is the CEO and founder of Wiz. When he raised his last fund, he started his last company, I'm pretty sure he gave a call to maybe 2 or 3 people, maybe even 1. So he picks his partners. And that's a really fundamental thing to understand about venture, is that if you are a top venture firm, if you're a top investor, you're most likely going to stay a top investor. And you just see this again in research and numbers. Like a top quartile fund is most likely to remain a top quartile fund, and a fund that is not top quartile is really hard. It's really hard for them to break into becoming a top quartile. So that's kind of that cycle. So for us as fund investors, part of our fund of funds, because I didn't explain actually the vintage whole structure, our job is to get access to the best fund investors and to convince them that we can be helpful to them, and we can discuss that too, and then increase our exposure and, at the same time, increase our impact and value to them over time.
I think you're right. It's a good time to just introduce vintage investment partners. If you could talk about the size of the firms to the extent you share the assets, the scale of the firm, and then the investment strategy more broadly.
So let's say cold hard facts, as you mentioned. So we're a team of slightly more than 60 people. All of us, except for one advisor, are based in Israel. We now manage roughly $3.6 billion across three different strategies. So we have a fund of funds that we just raised our 7th fund of funds a couple of years ago. It's a $631 million fund of funds, and it invests in early stage managers, mostly in Israel, Europe, and North America. So that's our fund of funds. We have a secondary fund. We raised it in 2021. We actually dry closed it. It's a $312 million fund. We dry closed it, and we started investing it, our 5th secondary fund, almost a year ago. And this secondary fund buys LP interests in VC funds, and also we're buying directly shares into company cap tables. And then we have a growth fund, which is sort of joke about this lately. We raised it at the end of the third fund, we raised it at the end of 2019. It's a $170 million fund. It's not a very typical growth fund because we're not writing $20 million checks and taking board seats in every company that we do. We actually want to be investing in the best companies with the best management and the best fund investors and try to be helpful there. And this fund, the reason I'm joking about it, although it's kind of serious and good, is that we're the slowest to deploy growth fund in the last cycle. So we started investing in January 2020, and we still have almost 40% to call in that fund. These are the three strategies. On top of that, we have the core IP of Vintage beyond the relationship with the managers is our database. It's the DNA that started the firm. When two of my partners started the firm, they've been collecting a lot of data, initially only on Israel, but then we broadened into Europe and the US. So now we have, proprietary private data of many, many thousands of companies. We were just thinking about like how we can leverage that, obviously for investing, but also for the better of the ecosystem. So we built sort of a managed marketplace that on one side you bring corporates that ask you about innovation. Israel, you might know, is deemed to be a startup nation, so a lot of corporates are coming here for innovation. Initially, we mapped to them Israeli innovation from startups, and now we do this actually globally. And the whole KPI of that service, which is entirely free, is to generate commercial agreements between those corporates and startups. So that's how we kind of, one of the ways we're trying to bring value and convince the best funds to take us as LPs and the best companies to take us as, as direct investors.
Super interesting. So there's three strategies. One is the fund of funds. The second is the secondaries into other funds as well as into companies. And then finally is the company investment fund. Is it fair to assume that kind of the core flywheel rotates around the fund managers? Like if you get the right funds and the right investors, the other two funds kind of enhance that, right? So if you've got investors that like a company, then you might do a secondary, you might do a co-invest or something like that. Is that the right assumption?
Yes, but also the other way around. So we would use, I'll give an example. So assume you're a small fund and you raised your first or second fund and it's all great and you're a great manager and whatnot, but you have one LP that never really got into venture, but you took them as because you needed money for the first or the second fund, and now they're not great LP for whatever reason, either proactively because they need cash and liquidity, or you kind of react to the fact that you want to build your LP base better. So the way we position and try to kind of create win-wins is like we're going to tell you like, hey, you send this capital call for the third time. This LP, is always late. Sometimes, you have to beg. Why don't we just come into his shoes and, replace them on your LP base and kind of start building the relationship. So, or if we might have already had the relationship prior to that. And similar, like assume you have a great company and now one of the founders, for whatever reasons, or there is a specific reason, decide to buy an apartment and they want to pay down some mortgage and they need $500,000, right? Like very few groups around the world know how to write like $500,000 or $1 million check for a specific venture company that is like a Series B, right? So that's kind of so it's all kind of tied together. And by the way, for the same reason, all of our team members in the investment team, we have about 15, which is quite a lot because we do a lot of things. We don't put them in silos so we don't have a fund of fund team and then a secondary team and then a growth team. Everybody's in the investment team, everybody's doing all of the strategies and all the geographies, because at the end of the day, the relationship is what matters. And actually the other thing that matters is the expertise. So I would do, for example, more fintech And I assume that's one of the reasons that we speak. So if there is like a relationship of one of my partners, but then they are discussing a fintech company, then I would come in and kind of give my input. But the team is across all three strategies. At the end of the day, like whatever underwriting you do, it's all about the underlying companies.
Let me ask you to dig deeper on the venture asset class. And we touched a little bit in terms of its returns profile being highly correlated with the performance of individuals, the performance of founders, using heuristics and intuition and access more so than some stream of mathematical information. In the fund of funds side, you're looking at what I assume is so many managers trying to raise money. What is kind of the profile of the asset class, right? If I'm an asset allocator and I'm looking at venture, if I'm looking at a fund of funds and investing in venture, kind of what's the pitch? Why would you want to own venture? And I guess part of the answer to this question might also be, how do you position the venture asset class to your own LPs? Like, what's attractive about it? What are the quantitative returns? How do you get through cycles? Let's start with that.
It's a really good question. It's more of a macro question, right? So I think most sophisticated LPs, they have allocation for privates. And then within privates, there is private equity, and within private equity, there is allocation for venture. So most of our conversations start there. Having said that, like we do have a lot of conversations with LPs that are just starting to build their venture portfolio exposure, and these questions come up. I think if you look back, depends on how much, but like if you look back, let's say 20, 25 years, top quartile venture has always beat public market returns, but median venture did not. So the thing is, you do want to have exposure to venture, but you need to know how to access and select. So that's kind of the first kind of pitch. And I think when you go back to what I said about like you are the best indicator to future success is past success. And again, it's backed by the numbers. Everybody is kind of crowding around specific names. So then it becomes an access problem more than a selection problem. And the next problem with venture is that it doesn't scale, right? So unlike private equity firms that can raise tens of billions of dollars and they can still generate kind of solid returns, at venture it doesn't exist. It's mostly elephant hunting, and at the end of the day, you have to hold significant amount of ownership in a few companies in order to make great returns, and it doesn't scale. So when you go beyond, let's say, a billion or a couple billion, it's really hard to do the 3, 4, 5, 10x funds. Almost impossible. And that kind of creates the kind of magnifies the excess problem. So that's kind of that. Within, if you compare private equity and venture, then I think in the past decade and a half, like on average, top quartile venture kind of outperformed top quartile private equity. So that's at a very kind of macro level.
To the point of it doesn't scale, I think that's very topical and interesting because we've seen a number of venture firms, whether it's Andreessen or SoftBank prior or Tiger, who might not have that sort of small shop or kind of like crafts like approach to venture, and instead trying to blitz scale everything and end up having inflated returns on paper, but then not being able to actually turn those into something that matters when the market turns or collapses or deflates. So I think there's some pretty bright examples of that.
Yeah, just maybe one point on that. So these are two. So you mentioned a few names. I would like to categorize those in two different categories. There is what we call it might not be a very nice name, but like there are those what we call the tourists. In most cases, they don't have venture expertise, and in most cases, they come into venture or tech very late in the cycle, and then they sort of disappear in a downturn. So this is one category of investors. The other category, and you mentioned at least one of the names there, is venture firms that just grow and scale to the extent that, it makes less sense in some of their vehicles. And, you can look at a bunch of names at like in this state from funds that were, sub-billion to many multi-billion dollar funds. And then both categories, and actually most venture investors, either those that came in before the beginning of the cycles or within, they all, like on average, all of them kind of invested too much, too fast at too high valuations, right? but that's kind of just wanted to put the distinction between these two groups.
Yeah, absolutely. And then, you have strange incentives for places like Tiger or SoftBank that might not be applicable to the average firm in the space. You mentioned access and kind of past performance as key issues to getting into a good manager. Are there other things that you look at to target, a good potential investment? Like, surely there are funds you look at that might not be as popular or that are more like a hidden gem. Like, what are the things that you think are like discoveries for you when you're sifting through potential investments?
Ultimately, the past performance kind of incorporates a lot of things that can generate past performance. The general theme, or at least what we're trying to build, and I would say maybe sell here at Vintage, is just being able to be on top of the market and find those hidden gems that you mentioned, just a tidbit before everybody else kind of recognizes that. So that we have enough time to build a relationship and get access and increase our position within the funds or the companies. And I'll give you an example because I think it encompasses a really good story of how we work. So when we decided to go invest in Europe, this was probably around 2010. It's not like we decided to go across Europe and then, we kind of segmented it by sub-markets because, to your point, by the way, venture is a sort of, I think of it as a very hyper-local business. Eventually, you need to be close to the founder. You need to understand their language. You understand their culture. You understand, everybody, people around them, and get the good references, or at least the right references. And then, so we started investing in the UK, and then we went into Germany, and then we discussed the Nordics. And every time we go into a sector or we go into a geography or a sub-geography, it's sort of a study. And the reason we decided to go into the Nordics was that we found that the ecosystem was favorable for several reasons: supply, demand. The ecosystem was healthy. There were some sectors like, let's say, gaming and e-commerce that was very popular, and somewhat fintech. So then we went and met like many dozens of funds in order to decide which fund or funds we would like to start with. And we met the guys at Creandum, and I think, the first fund was okay-ish, let's call it, back then. But then we realized that they have a fund where they are seed investors in Spotify, which is a company that back then was known to, some of the venture investors, but definitely not to the public. And they were also seed investors in a company called iZettle. I don't know if you know it, but it's sort of the European Square or Block. And again, not many people knew about that company back then. And we knew those companies are going to be really big companies. So that's kind of like the next thing is like the next thought is, if these companies are going to be really, really big, this fund is going to be very good performer. And it is one of the best funds ever in Europe, the specific fund that invested in Spotify and iZettle. And then the next thing is like everybody else would like to invest in Creandum. So we would invest in that. So we invested before kind of everybody else kind of recognized that Creandum is a great fund. And now it's one of the very best funds that exists in Europe, obviously. And it's, and if you are a new investor, like it's really hard to get exposure to that fund. They had access into that fund. Yep.
Super interesting. Can we add the dimension of industry on top? So we've talked about kind of venture in general. How do you think about fintech focused funds and crypto or Web3 focused funds? Is there any like amendment to your framing of the asset class or to the performance in the asset class for investors that are focused on fintech and on crypto? And in particular, I'm thinking about crypto funds having very short track records and often growing super fast for some really unusual or unpredictable reasons. If you look at multi-coin or things like that, and they're often like walking the razor's edge between blowing up versus being highly successful, like Three Arrows Capital. So how do you overlay kind of a industry intuition on top of the more general point?
I'll take the first general question about like industry specific versus generalists, and then we can discuss crypto as well. So on our job is obviously like to generate the best returns, and I try to explain how we try to do this adventure for a very long time now. But by the way, so we just celebrated our 20th anniversary in June. It's kind of a long way since my partner started Vintage. But I think up until a few years ago, we were very into generalist funds, and the reason, and then I think what happened a few years ago, and fintech might have been one, maybe it might have been the first industry specific funds that we did, was that we realized a couple of things. One, that there are like real innovation and in specific industries that, that can sustain having a very like, you could have a good fund if you're just focused on a specific industry, if the industry is big enough and you can, write checks to enough good companies, right? So if you think that, then, an industry specific fund is viable. And then the other thing is that we realize that, and to your point, like I mentioned before, in order to be a good investor, I think of venture as a hyper local business. I also think today smart founders are looking for industry expertise in their investors, right? So, and if you are an investor that focuses on a specific industry, then obviously you have more to give to the founders, right? So that's helpful. It doesn't mean that you're going to be an amazing investor, but it's helpful in the sense that it's easier to help and sell yourself to the best founders because you're going to eventually understand better the business, quicker the business, and, more likely you've seen that stuff before, either exactly or a very similar situation. So that started with fintech, I think, a few years ago. And again, it's not like we kind of went all in, but we invested with Ribbit. And then that's in our access fund, like the fund of funds that is investing in the kind of the brand name funds. And then we also have a smaller fund of funds that invest in, we call it Breakout, that invest in smaller managers. And there we invested in a fund called Better Tomorrow Ventures. But that's kind of the industry specific. So to sum it up, I think we want to see, like, we compare funds by what we think could generate returns. So you have to have like a very large industry in order to have an industry specific fund. And then you also have to have the expertise, obviously. So that's that. I don't know if you have other questions on that or you want to move into crypto.
No, that makes sense. So the point being is like you can probably generate good returns in most sectors, but when you have specialist funds, at least now, those specialist funds have often more credibility with, their particular stakeholders. And I think, just from personal experience, like having lots of exposure in the fintech industry is really helpful for seeing where the entrepreneurs are. Whereas if you're a generalist coming into the space, it's like, how do you reach people? And so building out distribution channels, networks, all of that.
Yeah, agree. Having said that, a lot of the brand name funds, they do have fintech, either a fintech practice or the very list, like have a fintech partner, right? So it's not like we're not getting exposure to fintech or to cyber by investing in generalist funds. It's more like, do we want to double down because we think this is like an amazing group that will get the access to the best entrepreneurs in that space. So that's that. On specific on crypto, so I was kind of the crazy guy running here in I think in early 2017, saying like, and it goes back to what I mentioned about us kind of figuring out just a bit earlier before everybody else. And I was like, hey, there is this sub asset class or whatever you want to call it that's happening here, this whole revolution of distributed networks and distributed compute and whatever in the blockchain. And we have to kind of get some understanding and exposure into that space. So we did quite a lot of legwork and we met many dozens of managers. And I think what convinced us to go into crypto, and we did that eventually with the first Andreessen crypto fund, was that almost every generalist fund that we talked to back then was saying most of our most talented founders, like the most talented founders that we meet right now, are going to start stuff in blockchain or crypto or Web3, whatever you want. Back then it was not Web3, but it's all the same thing. And I think again, going back to what we discussed initially, like eventually the founders are the ones that you trust will pave the way to the innovation. And the job of the venture investors is to be able to invest in the best founders that have, like, let's call it a fundable ID that can potentially be a big innovation. And when you hear again and again and again from, the best managers in the world that all the best talent is going into crypto, say, hey, we have to have some skin in that game. And that's obviously kind of the biggest driver, but obviously you should also have some thesis about the sector and we think about the technology and what can happen and so on and so forth. And then I think what happened was almost kind of the perfect storm, both positively and negatively at the same time. So all those early stage crypto investors were riding the adoption wave, and I would say the more experienced ones were also fortunate and smart enough to generate distribution during the boom between 2020 to 2022. And then to your point, a lot of them again scaled unproportionally. But then the other thing that happened was that, two main things. One, many scammers got into this game and kind of polluted the ecosystem. And the other thing is, to be completely honest and fair, there is still no clear kind of winner use case that you should say, hey, this great technology is going to solve this and that because. So now I think we're kind of in a in-between zone where, a lot of people trust the technology. It's in the hands of many people, especially the young guys, the young age. But at the same time, you're like at a place where most investors were hit by what happened recently, and even more importantly, regulation is kind of very unclear, right? And this headwinds is kind of going to be around for the next, I don't know, for somewhat foreseeable future.
The Andreessen example is it's so interesting in part because them becoming bigger and scaling to a size that is really kind of beyond venture size allowed them to do really interesting stuff in crypto. From my seat at Consensus at the time, like we were across Andreessen in a lot of DAO governance and saw them all over the place in terms of having meaningful stakes in lots of different protocols. And they had a tokenomics team and a token engineering team, governance, which I think is pretty forward thinking. Like not a lot of investors are building out kind of like core Web3 operating arms. And I think they've made a number of good investments, whether it's, OpenSea or Alchemy. But of course, everybody got caught in that valuation storm. And I think that's a good transition also to talk about structurally where venture as an asset class is today. I've heard from investors about the denominator effect. Like, since venture is not marked down as much as public equities, for example, like an asset allocator has more trouble giving additional allocation to new funds. The overhang in Series B where big companies have raised a bunch of money, their valuation's down, so they're not out of that money yet. Like, can you talk about what are the issues in the venture market, and then how do they clear over the next several years in your view?
Yeah. So I think from asset allocators' perspective, so let's say the large LPs or the family offices, the institutional investors. So I think probably most of them, if not all of them, had some type of not great experience in the past couple of years. Reason being, they allocated a lot of capital to venture. They were called for a lot of capital because funds were raising instead of every 3 or 4 years, but they raised every 12 to 18 months. And then most of that capital was invested, exactly to your point, like at very high valuation. By the way, irrespective of crypto, right? This is like, it's exactly as you mentioned, like it's a good segue into venture, a lot of growth investing either by those tourists or by the, you know, venture funds that became kind of either multi-stage or invested in growth and whatnot. So that was that. At the same time, I think we saw a lot of cash being distributed, a lot of cash and a lot of distributions in kind, meaning shares being distributed to LPs, but not at the same scale, right? So I think so. So I think there was much. The two, what I've been saying for quite a while now is that the two core factors that we're looking now, and I think most kind of more sophisticated investors look now for venture funds that coming to raise from them, is one, the pace of deployment in the last 3, 4, 5 years, and the slower the better. And the second one is just DPI. So if you have a fund that is a 2016 vintage or prior to that, and you don't have meaningful DPI, then I would say nowadays, if you're going to go to raise capital, like you're in trouble. You have a lot of explanations to me, which is the same words being saying in trouble.
Can you explain what DPI is and maybe give like what's a good benchmark for that number?
Yeah, DPI is distributed paid in, which means like relative to how much you invested in a fund. Let's say there is $100 million fund and you are an LP and you invested $1 million. So when you get distribution, meaning you got cash back of $1 million, then you're at the DPI of 1. If you got $500,000, you're at the DPI of 50% or 0.5. So I can give you like some numbers from a research we did in our database of many dozens of funds across. So what was interesting to see is that the multiple on paper of an average fund that was a vintage 2013 or 2014 was growing by late 21 to almost 3x net. Meaning, like, again, to our same example, if you invested $1 million, you would probably see in your reports that on paper you have 3 times that, like a $3 million in that venture fund. However, the DPI, and then a similar number to a 2015 or 2016 vintage fund, meaning a fund that started investing in 2015 or 2016. The difference was that the average or the median fund in our database got in early 2022 to almost 1 DPI, meaning you got your money back and you still have twice that amount on paper, right? While and that somewhat made sense because a 2013 fund going into the 2022, it's kind of at the end of the cycle, and most managers would think that they needed to sell their positions. So they made a reasonable decision to sell some of their positions, and they distributed quite a lot of capital. The problem was in the 2015, 2016 vintages that we looked at. Again, as I mentioned, on paper, you would see by the end of 21 or the beginning of 22, you would see that you have 3 times what you invested. That's called TVPI. Don't want to be too complex. But then there was a really big difference in the DPI between a median fund that distributed very little I think around 0.2 or zero point 0.3, while a top quartile fund in our database distributed about one time your money. And then we looked at the difference between the managers, and what was surprising or not surprising actually to see was that the top quartile fund in that vintages were like the more experienced managers that I mentioned before. So the point being, like, which was interesting because what we sell to our LPs is that experience matters, and we don't invest in managers that are not experienced, because downturns are when you're getting kind of tested, and experience kind of, we see this again in the numbers. Experienced investors perform much better in downturns, but we also showed that experienced investors actually outperformed inexperienced investors also in an up market, because they were like, hey, it's a really good time to get some liquidity back and show some cash to our investors.
Exactly. Unlike some long-term passive ETF asset allocation for private equity, you actually need to know how to exit. It's the lifeblood of the fund. So I know we're up on time, and I would love to send our audience to learn more about you and about Vintage. Where should they go to learn more?
We have a website, and we're kind of active and put a lot of content across social. So Twitter, now called X. We're on LinkedIn, now called LinkedIn. We're still not on TikTok. Our website is Vintage, and then minus IP, like the initials of investmentpartners.com. And there's a ton of content then there with, anything from video and audio and written blogs and whatnot. But everybody's welcome to take a look and reach out.
Fantastic. Asaf, thank you so much for joining me today.
Thanks very much, Lex, and I enjoyed it. So hopefully it was good.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.